Hi everyone, how are we doing? So this is the update for September. So we can see the value of the portfolio here is currently just shy of 18 grand, so 17,900. We can see here the dividends on the right, last month being a very low amount, £10.29. September's due to have a larger increase than August. We've got Intel, M&G and Legal and General, and then Aviva following in October. So we can see the portfolio here has slowly gone up. The last month has seen some reductions in the value, as we'll see shortly. Part of this is just due to market fluctuations being a great buying opportunity, and also because I recently, or not recently, a couple of months ago, moved over from trading from eToro to trading 212. So I didn't have as good of a positions as I would like, and I sort of bought in a bit earlier than at the bottom. But we'll go into the holdings at the moment, and then we'll also go on to BOTB and why I'm very bullish on this company. So we'll go through that presentation. So the portfolio here, we can see this one is 14,589 with a 962 in China stocks, Chinese companies, which we'll go through as well. So we can see here the top holdings are Alibaba down 13%. Burford Capital, we've seen some very good gains on this one recently, so plus 150. I'm very excited for this company. I wish I purchased a lot more. At the sort of bottom here, the fundamentals are incredible, and I'll do a video on this one shortly. The next biggest one, Corsair, seen a big hit recently. I have purchased more of this, however not as much as I like, as I've been favouring Alibaba and Best of the Best, or BOTB. So we'll see some recovery. I love the fundamentals at Corsair, and the purchase price I bought it at was still very cheap in my opinion, given the great fundamentals and the gaming runway and tailwinds that this company is currently operating within. So the next one is Intel, so down as well, so 53.46. I'll be continually buying this one. Again, the tailwinds are incredible. It's got the government support. It's entering the GPU market. They've got Pat Gelsinger in to really kickstart the company. So they're the top sort of 4 holdings here. And then we've got Aviva as well, which I've previously covered. So we can see here the portfolio's an all-time high, if you like. Invested is down about 400 quid. However, we have had some returns from dividends and realised profits of roughly 1,700. So net, we're still positive for this. We can see withdrawals here is actually the money deposited into the Chinese stocks we'll go on to now. So on the portfolio of Chinese stocks, we've got 360 Finance, which I bought on the massive decline that we've seen recently. I've done a video on this and why I still like it. So I initially exited my position around 30 on eToro. Didn't capture the 43 rise, however I have purchased again at around $20 average. The next one is Douyu, the Chinese streaming company. This is an excellent company and purchase price. I've done a video on this last time, and it was essentially selling for net cash, so you got a free company. If you look at the enterprise value, Huya, again, their main competitor, just as a general bet on the Chinese streaming industry, they've been heavily hit by the regulations, reducing the number of hours spent from children. However, they'll make up a small market, and also they won't be the large paying customers for these streaming companies that generally be more in the 20s with more disposable income. The next one, JD, seen huge gains recently since their earnings, a very good company. And finally Tencent, which I would like to have purchased more. They're such a great company, and 10 years down the line I can see them having over 2 trillion market cap, just as a rough example of how much they grow and the industry they're in, the low capital it takes. It's all very good. So going into the sort of beef of this video, BOTB. So onto the main part of this video here, we've got BOTB, or Best of the Best, which is a prize-winning auction sort of site where it sells on sort of cars, Rolexes, and even cash onto their viewers. So we go on to the sort of market view of this. So we've seen that it has actually lost significant value. since its all-time high, and we'll go into the reasons why and also why this has got excited. So to begin with, let's just see from the Google stats here. It's got 63 million market cap, a PE of 5.5, and is currently trading at £6.70 or 670 GBX, which is the same as pence. It's seen significant decline over the last year, down from an all-time high of 3,600. So about BOTB, so it's based in the UK, operates weekly competitions for luxury cars, it also operates competitions for prizes, motorbikes, watches, luxury gadgets, cash, technology and holidays. So it has a wide range of items, so it's not particularly focused, it's got diversification away from cars, and it operates on YouTube, Instagram, all of those sorts. So it's primarily used to operate in shopping malls and airports. So if you're from the UK, you probably would have gone to a shopping centre and seen like a Ferrari parked up. So this could have been them. The fundamentals here, so it primarily reaches customers through direct social media, and it actually saw a 264% increase in revenue, hence the large increase in their share price over the last year. So they had huge tailwinds from COVID. And they stopped physical locations, luckily, at the back end of 2019, so perfect timing. They could not have had a better strategic position for this company going to coronavirus. And that also increased the operating margin, profit margins from 19.8 to 25.2. They've reduced the number of staff, primarily probably the people on the floor in these shopping centres, from 76 to 21 over the last 6 years. They have a return on equity of 128%, return on capital of 156%, which is up from 100% 3 years ago. So this company is just shitting out cash and profits, which we'll get onto very shortly. So the company's currently trading, like we said, at pretty much the all-time, or the 52-week low, down from the all-time high of £36. It's primarily reduced to the 2022 outlook for the management team, so they're seeing reduced engagement compared to the coronavirus times. Obviously they saw 264% increase in revenue, so it's expected to see some pullback in that as people have more income to spend going out to the pubs or just going out as they would do before. They've also seen higher marketing costs from the likes of Facebook, Instagram, Google, just people really ramping up their costs. However, they've got a capital light model here, so 21 staff, and they're able to get 45 mil of revenue. Is very good. So we'll run through the valuation and why this could be a great multi-bagger if you look past the short-term decline. So the company, the valuation here, we'll go on to it. So it's seen incredible growth in the share price, down 80% since April 21. I believe it's important to note that 49% of total shares are held by insiders, so it greatly aligns their interests with that of the shareholders. And the market cap, as we said, 64 million with a net cash of 11.8. So they've got zero debt. They've got 11.8 mil in the bank. So that gives an enterprise value, which is the market cap minus cash plus debt. Obviously, debt zero of 52.2 mil. And most recently, the earnings before interest and tax is 14.06 mil. As of 2021, free cash flow of 12.43 mil. So that's just taking into account some taxes. So we get an enterprise value to EBIT of 3.71, and the most recent PE is around 5.6. So great value at the current earnings. Obviously, we're going into why the earnings are going to reduce and why the investment community is pricing this so low. So if we look at the income statement here, we can see the revenue before was 17.8 mil, and now it is at 45.6 as of April 2021. The profit for the last year is 11.494. The EBIT, which we used, was the 14.063. So we can see here that they've had a large profitability. Even before last year, they had 3.5 mil profit for the year. They have a very capital light model here, so we can see the assets are only 13.3 million, of which 11.8 is cash. So they've got very low plant. So only 1.1 million in property and plant. And so it's great shareholder equity. They've got absolutely no liabilities. We can see here trade and other payables. That's likely just the payment of prizes on their competitions, along with tax. So they're really just no liabilities, very capital light. So we look at the cash flow statement here. So net cash from operating activities, 12.5 mil, and this equates to a free cash flow of roughly 12.4 mil, as we mentioned earlier. So we can see here they've got very low cash expenditure. So purchase of intangibles 84,000, and purchase of property, plant and equipment 67,000. So very low capital expenditure required for this company. So why is this company so poorly valued? So the trading update as of August 8th, sorry, doesn't read well for those already holding the stock. So obviously we've seen a large 80% reduction. The company reported that revenues from existing customers have been down 15% in the past 15 weeks, whilst also having increase of up to 60% in marketing costs, as we mentioned. So squeezing the margin and taking less revenue for this last 15 weeks. So thinking about how we're going to price this. So I've done a DCF here. This is not the value, the be all or end all value. This is just a rough finger in the air, assuming a 20% growth rate over the next 5 years, and then a subsequent 5% increase in growth rate, which is well above their average of around 20% a year. The company is still at a discount of 52%. So given the cash flow we can see here from year 1 to 10 plus the terminal value equates to roughly 125 mil plus the value of the current cash at 136, and the cash is likely to grow. Obviously we've seen that they have very low expenditure, very low assets and liabilities, so there's really nowhere for that cash to go other than dividend payments or reinvestment into the business. The bear case here we can see, so I've added another growth rate, so 1 to 3 minus 25%, growth rate 4 to 6 years in minus 10, and then a subsequent 10% growth from that low base, which you can see here gets down to about 5 mil between years 7 and 10. Using the same free cash flow and cash, it's still 36% undervalued. The second bear case here, just to really punch home a conservative valuation, we're saying they're going to have 10% growth rate from the next 3 years. Bear in mind we're using the previous year's free cash flow, so 5 mil down from 12 mil. A growth rate of 4 to 6, 5% obviously again from this reduced free cash flow value of 5 mil down from 12 mil, and then zero growth years 7 to 10. So that is where we can see the stock is currently trading around this intrinsic value. If this wild speculative case were to happen, that the company reverts back to the same cash it did last year, had no growth for the next 3 years, and then had very poor growth for the remainder. And then the bull case, so we can see here a reduction in earnings for the next 3 years of 20% a year, and then subsequently 20% growth for the next for years 4 to 6, given their historic growth rate, and then a slowing down of 10% years 7 to 10. So we can see here the stock is at a 68% value reduction value to where this company could be. So really this is the case for this company. It's had an excellent couple of years. The share price is absolutely tanked, and I really believe it's a really good buying opportunity for this. So I'll be continuing purchasing around £7. Hopefully it'll go lower, and we'll see the next trading update to see how the company's earnings have shaped out. So thank you very much. Cheers.